Who else is a founder? A founder of a startup? Yes, what's your name? Carolina. Carol and Carolina. Nice to meet you. And what's your, what are you working on? What's your business all about?
Startup is called
Banki?
It's a portal for developing financial intelligence for children.
Financial intelligence for children. Yeah. Very cool. And who do you sell to? Yeah.
I'm thinking of banks.
Uh-huh.
I think I need to develop more.
Yeah. Right, pre-launch. No, not launch the product yet. How long have you been, did you quit? I imagine you maybe quit another job to do this? Or are you still doing your other job at the same time? Or?
Actually, I'm working for a VC fund. So
Cool, which fund?
Which VC fund?
Yeah.
Startup
Okay, cool. Nice to meet you. Okay, one more. Just want to understand who we're talking with. There was one guy over here. Yes, in the white sweater. What's your name? Peter. Nice to meet you. What's your startup? What's it called? Great. And are you in business now? Is it almost? Good luck. What are you hoping to accomplish over the next, you're hoping to launch your product? Yeah. Cool, great crowd. Nice to meet everybody. Okay, so how not to fuck yourself when negotiating your first financing. A couple things we want to talk about. Talk a little bit about process, and then talk a little bit about kind of what you should care about in a financing. So even if you've negotiated a financing before, and you're coming back for your second one and negotiating with an investor, you're at a serious disadvantage. You know, this is maybe your second time. If you're pretty experienced, this is your second time negotiating the financing. The investor this is their second financing this month, right? They've probably done dozens and dozens, and then previously they had their if they ran a business and raised venture capital in that business, they have even a longer history and longer experience of having raised money and negotiated financings many times, and they've had the advantage of seeing the consequences of what you're negotiating more than you have. So you have this disadvantage, and it's very easy. It's very easy to get intimidated by the process and by the terms. There are a lot of terms to negotiate in a financing. Let's actually that could actually be kind of interesting. When you're negotiating, let's say, an apartment to rent, you negotiate the price of the apartment, maybe kind of whether you have to pay for the utilities and pay for water and pay for garbage, or whether the landlord's going to pay for that. There's a kind of a handful of terms that we're familiar with. When you're negotiating a financing, what are the key terms? What are some key terms that you can think of that you have to negotiate in a financing? Rebecca? No idea? No? Interest rate. Okay, interest rate. Anyone else? Let's try to get five. 5 terms. Right, what type of investment? The instrument, we call it the legal instrument, whether you're selling equity or a convertible note. Okay. Anyone else? Let's get 3 more. Yeah? Yeah. Responsibility, right. Your obligations and sort of secondary responsibilities and obligations that come with the investment. How much you're raising? Yes. I was going to say let's be even more basic, more basic. How much are you raising? That's a good term. Let's get one more. Valuation. Excellent. So I think that's 4 total. Maybe let's do one more. Anyone? One more term. Market cap. Sure. We'll go with that. Good. Could probably add about 20 or 25 more to this. There's a lot of terms that get negotiated. But as I said in the beginning, my objective is not to give you some big long list of terms, a whole bunch of new stuff you have to learn. My goal here is to simplify the process. And so we're going to say that there are only 2 terms that really matter. Or let me phrase it differently. All of the different terms that get negotiated fall into 2 categories. They're just 2 fundamental categories. And they all come down to money and control. Okay? Money and control. And when you're negotiating your first financing, or even your second or your third financing, and you're a typical startup founder, and you're trying to act like you know what you're talking about, and you're trying to kind of bullshit your way through something that you only know know the answer to, 50%. It's very easy to get in a situation where the investor says some term and says, oh, we'll do standard such and such. And you say, oh yeah, of course, standard such and such, and you agree. But you don't know what you agreed to. And what's worse, whenever someone uses the word standard, that means non-standard, okay? Right? Whenever someone uses the word standard, that means non-standard. So you can really get swept up into this situation where you're agreeing to stuff because you don't really understand what's going on. And sometimes people will wonder, well, should I bring my lawyer to the conversation, to the negotiation? How do I level the playing field? This is my first financing. The investor has done, 20 financings. How do I level the playing field? Should I come with my lawyer? I don't recommend that. I don't think that's a good idea. I think you really do need to have initially the negotiation has to happen between the founder and the investor. The lawyers will come in later. But in the beginning, when it's the founder and the investor negotiating, you do have to be able to address these two fundamental points about money and control. And the objective of my talk here is to prepare you to talk about money and control to the extent that you need to be able to without help. Okay? To the extent that you need to be able to without help. Then once you cross that point, you bring in help. But by that point, the conversation should have advanced to a point where there's starting to be a relationship, and it's not a lawyer-driven negotiation. You never want to be in a lawyer-driven negotiation. The negotiation should start with a business deal. And so my objective is I want you to be able to get onto a good understanding with your investor on the 2 points that matter the most, and to have the confidence to then say, if the investor raises other terms, say, I don't know that term, let's leave that to the lawyers, okay? But I want to equip you to be able to talk about the two things that really matter the most. So, money and control. All of the terms boil down to money and control, and we're going to talk about a couple points under each, really just one point, under a couple points, 1 point, I don't know, under each one, so that you feel confident, and that for anything beyond that, you can feel like you don't feel pressure to understand it, at least not at first. So money and control. How does control work in a company? How does control work? Who controls the company? Who controls the company? Any ideas? CEO? Board of directors? The CEO? Yeah? The market? The owners? Yeah. Is there a Polish lawyer in the room? Is there a Polish lawyer? Yes. Rafa? Oh, nice. Cool. Please speak up if anything I'm saying here. I'm going to keep it very basic, and I think this is the same in Poland. Let me know if this is a little different. I'm sorry? Who can sign the check? Yeah. So there's many layers of control, all right? There's many layers of control. The head of a certain department kind of controls what goes on in that department, and the CEO kind of controls what goes on in the different departments, and the board controls who the CEO is and controls what to a certain extent what the CEO can do, and then the stockholders control the board, right? Don't bother memorizing all that. The point I want to get at is that when you're negotiating a financing, the key control point that you care about, when you're negotiating with an investor is control of how the board gets elected. All right? That's the key point. How the board gets elected. Now the default, this is true in the United States, and in the United States, I think this is true in Poland. The default is that the majority of stockholders elect the board. Okay? The majority of stockholders elect the board, and the stockholders kind of control who's on the board. But when you negotiate a financing, you negotiate an agreement with the investor about who you're going to vote for to put on the board. Okay? So here's kind of how it works. You don't need to understand all this level of detail. We're gonna come back and make it very simple again, and there's one simple point I want you to understand. But here's a little bit of the underlying structure. When you negotiate a financing with an investor, you negotiate who's going to be on. You negotiate not so much who's going to be on the board, but who's going to pick who's on the board. Okay? You negotiate who's going to pick who's on the board, and that's a really important difference. Okay? It really doesn't matter who's on the board. What matters is who picks who's on the board, okay? And the default is that the majority of stockholders get to pick who's on the board, but as part of the financing, you typically will enter into a contractual agreement with the other stockholders about who they're going to vote for, okay? You enter a contractual agreement with other stockholders about who you're going to vote for, and that's where you decide who gets to pick who's on the board. So for example, where's Nav? Okay, Nav starts a company, and Rafal start a company, and they go and they raise money from Saul, and they reach an agreement that that the board is going to be 3 members, and 2 of the members are going to be chosen by Nav and Rafal, 2 are going to be chosen by Nav and Rafal, and 1 is going to be chosen by Saul. Okay? It doesn't matter if Saul picks himself, or if he picks someone else, or if Nav picks himself, or if Nav picks someone else. It doesn't really matter. What matters is that they have the ability to change the directors and replace the directors and pick who's on the board. So that's really the key thing that matters. Now, what should you be looking for when you're negotiating? Does this work in Poland? Is this kind of true? Okay. So when you're negotiating this board structure, this board control with an investor, you want, as a founder, you really want to retain control of the board, okay? You want to retain control of the board. And what that means is that if you have, say, a 3-person board, that you and your founders, you want you and your co-founders to be able to elect 2 of the directors, 2 of the 3 directors, okay? That's board control, at least that's board control. Now, there's a lot of variations off that. There's a lot of different ways to structure the board that sound like the same thing. They sound similar, but they're different. So here's an example. We're going to have a 3-person board, one director elected by the founders, 1 director elected by the investor, and 1 independent director. Sounds very fair. It sounds very, very fair. It's very difficult as a founder who's negotiating an investment for the first time. It's very difficult to say that sounds terrible. Sounds very reasonable. And it is reasonable. But you don't have board control. And in my experience, let's back up. What's an independent director? An independent director can mean a couple different things. Usually it means a director who's not a stockholder or who's not an employee of the company. They're someone who doesn't really have any connection to the company other than the fact that they're a director. That's usually what people mean by independent. There's some other things people mean. Like, for example, it can be someone who's elected by the investor and the founder together. Sometimes we call it a mutual director, but it's basically the same idea. But that sounds really reasonable, right? A founder director, an investor director, and an independent director. But you've lost board control at that point. In my experience, the independent director tends to side with the investors. They tend to side with the investors. And we don't need to be cynical about that. It's a very natural thing. You, as a young founder, maybe have 1 or 2 friends who could be that independent director. The investors have 20. They have a whole Rolodex of people who could be the independent director. So it's very natural. It's very, very natural that independent director is probably going to come from the investor's network, the investor's Rolodex. And there's going to have other relationships with the investor, and it's a very natural thing. But the result of that is that the independent director will typically tend, in my experience, to look at problems in a way similar to the investor. They'll tend to be fairly sympathetic to the investor, and so that's one, you've literally lost control, but 2, that the independent director tends not to think of your company the way you do. And then 3rd is, as you go on to raise another financing, right? Let's say you go to raise a Series B round. Well, you came into the Series A controlling the board, and you gave up board control at the Series A. Going into a Series B round, the Series B investor is going to want a board seat too. And it's like not your company anymore, right? Then you'll end up with maybe a 4 or 5 person board where you have one seat, Series A investor has one seat, Series B investor has another seat, you have this independent guy, and it's like not your company anymore. And this is all stuff that happens very naturally. There's nothing malicious going on here, or this is just how things happen naturally. Okay, so we talked about one, just to recap. The board structure that you really want in order to retain control is 2 seats elected by the founders and 1 elected by your director. But there are other variations that sound similar but are actually different. And one that sounds similar but is different is 1 seat by the founders, 1 seat by the investors, and 1 independent. Sounds reasonable, but we just talked about why it's a problem for you. Here's another one. Now that one was kind of obvious. Here's another one. It's more subtle. We're going to have a board structure where 2 seats are elected by the founders. Actually, let me change how I describe it. We're going to have a board structure where it's three board members. One is a founder director, anybody you want. The other is let's see. I'm trying to think of a way to say this that sounds, or it's hard to hear what the problem is. Let's say we're going to have a 3-person board seat, and one is a CEO, it's you, a founder. One's a CEO, the other is another director elected by the founders, and then an investor seat. That sounded really reasonable, right? Sounded really good. Sounded like not a problem. We're going to have a 3-person board. One's going to be the CEO and founder. You're CEO, so you're on the board. We'll let you elect another seat, a second founder seat, and we'll have an investor seat. That sounds like you're retaining board control, because you have two founders on the board. But a CEO seat is not a founder seat, right? Because if you're no longer the CEO, then you no longer get to control that seat. It's whoever happens to be CEO gets put in that seat. And you'll hear a lot of different arguments for why that's a good way to do it. A lot of times an investor will say, and they'll say this totally, there's nothing malicious here. It's a very reasonable way to look at it. They'll say, the CEO should be on the board. What's wrong with the CEO seat? The CEO should be on the board. You don't want a company where the CEO is not even on the board. And as a first-time founder, that's a very difficult argument to rebut, right? It's very, very difficult as a founder to rebut that argument because it sounds so reasonable, and it is reasonable. It's true. It's completely true. The CEO should be on the board. But that's a different question from who controls the board, right? The CEO should be on the board, yes, but that's a different question from who controls the board. And when you say that one of the seats is a CEO seat, you no longer control who's in that seat, okay? Sometimes you're not the right person to be CEO. Many founders don't want to be CEO after a certain point. And what happens there is, as you kind of go into, you always have to think about your next financing and your next financing. If the company is successful, you're going to raise more money. It's kind of counterintuitive, but the more successful it is, the more money you're likely going to raise. And at each round of financing, you give up a little bit of control. And so as you go into the Series B financing, you're going to be negotiating and using one of your negotiating chips, right? Using one of your negotiating chips to retain that board seat. And you don't want to be in a position where you're having to do that. So that's another formulation that sounds good, sounds reasonable. One CEO seat, another founder seat, and an investor seat. But it's not quite what you want. What you really want is 2 founder seats and a CEO seat. 2 founder seats and an investor seat. We'll go a step further, and then we'll take it back and make it simple again. In my experience recently, we've had a lot of success getting 3 founder seats and an investor seat. And that's wonderful, because then when you're going into your next financing, you already have enough seats to add the Series B investor without losing control. If you have 3 seats going into a Series B financing, and your Series A investor has 1 seat, and you go into the Series B and you add a Series B investor to there, you still have board. You have 3, they have 2. You still have control, and you have it set up that way without having to negotiate for that with the Series B investor. Now, how do you do that? In my experience, it's very, very rare. Very, very rare. I've done it a couple times, but it's very rare that a founder can get 3 board seats going into a Series A financing. Almost impossible. However, shortly after the Series A financing, it's a lot easier to expand your board control. It's a lot easier because there's a psychological dynamic that happens in a financing. you're out on the road, you're meeting with investors, you're fundraising, you're talking with lots of investors, hopefully getting a bunch of term sheets maybe, and it's very intense, and you don't want to blow the deal, you don't want to be too greedy and ask for too much, right? And so you don't ask for 3 board seats. Also, the investor is just now getting to know you. They're just starting to get to know you. They're hopeful, they're optimistic, just like you. They're hoping for the best. They know that a lot of times it doesn't work, but we're all in this strange business where failure is very common. And so they don't quite want to give you quite that much board control going into the financing. But during the 3 weeks between when you get a term sheet and when you get the money in the bank, it's kind of generally 2 to 3 weeks or so, if the deal goes quickly, a relationship develops and trust develops. And when that money hits the bank account and you then go and do business together and the investor's on your side, you have some board meetings, very, very quickly a whole level of trust will develop, hopefully. And it's much, much easier at that point to ask for the additional board seat, in my experience. A lot of times, that's one kind of step of preparation for a Series B financing. So rather than waiting for the Series B financing and asking the Series B investor to expand your board seat, you kind of do it between the A and between the B as you're getting ready for the B, so that you don't have to use that as a negotiation chip when you're negotiating with your Series B investor. So you kind of get it set up in advance so that you and your Series A investor are well positioned to negotiate with the Series B investor. Just a little thing to keep in mind. Okay, so let's keep it very simple. The one point, a quick recap. All of the terms that you negotiate in a financing fall into 2 basic buckets: money and control. Control comes in various different forms. There's various different layers of control. But the one that you care most about as a founder is not who's on the board, but who elects who's on the board. And you want to elect 2 seats, and you want your investor to elect 1 seat, your first investor. You want your investor to elect 1 seat. You want to elect 2, and you want your investor to elect 1, and you don't really want variations off that if you can help that. Anything beyond that in the control section, in the control kind of side of the negotiation, anything beyond that, you feel totally confident to say, I don't know, I'm going to talk to my lawyer, or I'm going to talk to my advisor. It sounds a little bit better. Lawyer sounds a little aggressive. I'm going to talk to my advisors, and we'll come back to you. I don't know. You should have the confidence to say, I don't know. There's all different kinds of topics that come up in the control section. Other topics, rights of first offer, rights of first control, what are we talking about? Control? Rights of first offer, rights of transfer restrictions on your shares, protective provision. I mean, you can go on and on and on and on about different kinds of control. None of them matter as much as board control. And if you win on the board control topic, it sets a clear theme for the other topics. Okay? Okay. So that's control. How are we doing on time?
10 minutes.
Oh wow. Okay. Money. Money. Let's talk about the money side of the term sheet. How is valuation determined? How is a valuation determined? Anyone know?
You should get as much money as you have to accomplish the next goal.
Yeah. Actually, that's very, very close to, I thought we were going to start over here and then I was going to take the conversation over here and make a point, but you're very close to that point. No, it's good, it's good. That surprised me. We'll come back to that. Other additional ideas about how now everyone feels like any other answer is going to be a wrong answer. Okay, so I'll just say what I was going to say. So there's a basic formula for thinking about valuation. If someone says, "I'll give you $1 million for 25% of your company," okay? I'll give you $1 million for 25% of your company. What they're saying is that after you get my $1 million, your company is worth $4 million, right? After you get my $1 million, your company is worth $4 million. 25% of that is my $1 million, and the other 75% is the rest of the company. Okay, so we say that if someone says, "I'll give you," so if someone says, "I'll give you $1 million for 25% of your company," they're saying that your company has a $3 million pre-money valuation, a $3 million pre-money valuation, or a $4 million post-money valuation, okay? And so sometimes people will abbreviate this and they'll say, I'll give you 1 on a 3 pre, 1 on a 3 pre, or 1 on a 4 post. Okay, they're saying that they'll give you $1 million for 25% of your company. Now, the 2 key terms there that you care about really are how much money are you getting and how much of your company are you giving up, right? How much money are you getting and how much money of your company are you giving up? And what determines that is really this concept of the valuation. But valuations are impossible to negotiate. Absolutely impossible to negotiate. You cannot negotiate valuation. It doesn't, there is no way to negotiate it. If you're talking about a publicly traded company, especially a company with high trading volume, the valuation question is very easy. You just say, well, here's the price that people are trading at. That's the value. With a private company, it doesn't work that way. There's no trading that's happening. There's no kind of easy answer for the valuation question. And so you get into this weird debate where the investor thinks of the last 5 or 6 deals that they did and where your company compares to those other deals that they did, and they say, I think that you're bigger than this company but smaller than that company, so your valuation is such and such. And you get into this negotiation where you're saying, yeah, but I don't want to give up that much of my company, right? But you're not talking about valuation. No one's really talking about valuation. And there's a reason why valuation is difficult to talk about and difficult to negotiate with private companies. And the reason is because this whole kind of startup industry is based on a assumption and a hope that you're building something that has some crazy value to someone in particular, even if it doesn't have that value to the whole marketplace. Right? So when you're building a company, you're hoping to build something that's super valuable to maybe a dozen big companies. Right? A dozen big companies, and that has some strategic value to them, where they will pay some obnoxiously large price for what you've built. Right? So was it Google acquired Waze? There's probably very little revenue. I don't know much about the Google Waze. I don't know why I'm using that as an example. What's a good example? Let's use it. Google and Waze. Waze didn't have a lot of revenue, didn't have a ton of revenue. Google certainly did not acquire it for the revenue. They did not need the revenue. They needed it for the users and for the penetration into the users and to expand Google's product offerings. It had a strategic value to Google. Now, did Microsoft need that? No, probably not. Did IBM need that? Probably not. Did some oil company need that? No. These are not objective, these are not financial. When you talk about public markets, people are investing for financial reasons. You buy low and sell high. But this industry is not based on that. This industry is based on building something that has strategic value, unique value to a particular buyer that may not have the same value to another buyer. It doesn't really matter. Doesn't really matter. So the whole idea of valuations is kind of weird in our industry. So that's one thing to keep in mind. Another thing to keep in mind is that 5 minutes. Okay, we'll wrap this up. When you present, well, let's just say, I think the way to think about valuation when you're negotiating with an investor is to think about how much money, so my point was that you can't negotiate valuation directly. This is you can't negotiate valuation directly. There's no way to negotiate valuation directly because our whole industry is based on this premise that valuation is kind of weird and unique and kind of irrational in a way that we like. So how do you do it? So how do you negotiate valuation? You can't negotiate it directly. So instead you negotiate the other two things which influence valuation. You negotiate how much money you're getting, and you negotiate how much of your company you're giving up. Those two things you can have a very real negotiation about. You know how much money you need, right? You don't determine how much money you need based on objective market conditions or something. You know how much money you need. You have a business plan. You have goals that you're trying to reach over the next 18 months, and you raise the money to achieve those goals. And it's different for every business, and you can have a very real discussion about how much money you're raising. How much of your company are you giving up? How much of your company do you give up? Well, the way you attack this part, the way you negotiate this part is a little bit different depending on what kind of investor you're talking with. But if you're talking to an investor who invest regularly in venture-backed startups, they know that the successful companies are going to raise multiple rounds of financing, right? The successful companies are going to raise multiple rounds of financing. So if they're thinking that your company is going to be a successful company, which hopefully they are, I mean, you all are, that's why you're doing this deal, it's in their interest and in your interest to not give up too much of the company. Right? If you're going to raise multiple rounds of financing, at each round of financing, you're going to give up some of your company. Well, you don't want to be in a situation where you're trying to raise your Series C financing, but the founder only owns 2% of the company, right? Nobody's going to invest in a company where the founder doesn't have an incentive to keep working, right? And so it's in your interest and it's your investors' interest for you to guard and for you to protect your equity and to hold on to your equity, just like you're going to guard and you're going to protect your finances, and you're not going to spend money like crazy, and you're not going to buy crazy, throw crazy parties all the time and give your salespeople crazy expense accounts. You have to guard your finances, and you have to guard your equity as well, because that's the tools that you're going to use to hire people, to raise more money, and to grow a bigger company. So, taking a big step back. Valuation is determined by how much money you're taking in and how much equity you're giving up. But you can't negotiate valuation directly. You cannot. All you will do, if you try to negotiate valuation with your investor, all you'll do is damage the relationship, because it's like having there's no way to have a productive conversation about it. So you talk about the other two things. You talk about how much money you're taking and how much money you're giving up. And is that it? Time. Okay. Anyone wants to talk about additional points to talk about how do you, more thoughts on how do you negotiate the amount of money that you're taking? That's a topic I'd love to talk more about. You can find me afterwards. I'll be around today and tomorrow. Thank you.